Hello, my name is Nick Quinn. I'm the CEO of FT UK, and it's good to see you. I hope you are well and you've had a good end to the month last week. We are straight into May, and I think it's going to be an interesting week ahead. We're going to look at a couple of markets, but the old adage of should you sell in May and go away, is it going to be true this year? I guess we'll find out. But before we do, the Flex Challenge is something that you should definitely consider. It's our new challenge that we have at FT UK, and it's extremely popular. And the reason is it's only $9 to get started. Very simple structure, very simple rules. You pay that entry fee of $9 on any of the different sizes from 5,000 all the way up to 100,000, and then you can pass the challenge, pay the activation fee, and then you've got a funded account, and it is a fantastic way to carve out some green pips for the month of May. Okay, let's have a look at a couple of core markets and opportunities that you can take advantage of this week. I'm going to look at something early in the week on Tuesday. That's the RBA interest rate announcement, where they are set to increase interest rates from 4.1% to 4.35%. And then also, it's obviously jobs week as well. Throughout the week, we've got JOLTs, ADP, and then non-farm payrolls on Friday. So I'm going to look at the S&P towards the end of the week for the NFP, simply because we're printing at all-time highs, and I think there's some interesting stuff fundamentally that is going on behind that. But first up, let's talk about the RBA. Now, this is an opportunity that is quite easy to take advantage of, particularly if you're in the US and it's the end of your day session. If you're looking for an intraday trade, interest rate announcements can be particularly profitable from an intraday perspective. And what I really like about Asia Pacific interest rate announcements is the way that they show their hand on the cross currencies. So classically, you may say that an RBA interest rate announcement was best played between the Australian dollar and the US dollar. It's not always the case, because geographically, the active currencies around Australia, they tend to be the ones that get the most impact when we get volatility from those kinds of announcements. So for me, I would pick anything other than the US dollar to express some kind of an intraday trade on the RBA interest rate announcement. So I've chosen the Australian dollar against the Japanese yen for good reason as well, because obviously most people will, if you're a currency trader, you will certainly know that the Japanese intervened in the yen last week, and that has obviously given us a massive repricing as the yen has strengthened. But against the US dollar, that is one thing, that's where most people would measure it. But if you're looking to play the RBA, it's a really interesting prospect against the Japanese yen, simply because, as you can see here on this daily time frame, we are in quite a nice area of new territory. That gives us really nice two-way action on the volatility that you could potentially going to get from the interest rate announcement. Keep your eye on the 24th of April. This is a doji that you can see here. That is for an upside target here at 113.88. That will be a limit for me to the upside, certainly intraday, and we've got to get through Monday's session before we get to this. But then as you start to drill down to the 4 hour, you see a really classic consolidation pattern starting to form now. It looks, I think we're going to get a nice pennant forming now into the end of Monday as the market quietens down before the interest rate announcement. And a pennant in a downtrend is usually a good hallmark of a market that's moved far too far, far too quickly. And you can see that intervention candle there. A really, really big move for sure. So just for me, I would keep it nice and simple as always. There's no need to do anything fancy with it, but just drawing some trend lines on to highlight where that pennant is. Bear in mind, it's a very, very good indication of a market that's gone too far. It's just resting up, and they do go very, very quiet before they then explode again. So it's bang for your buck, I would say, on Tuesday. And you generally see a pennant that is horizontal most of the time, but you do get them upwards in a downtrend, and this definitely is giving us a flavor of that. 113.88 will be an upside target on that. I would let that play out, but I would be looking for some kind of a volatile move that gives us another push lower, and then you're obviously then starting to target these lows from the intervention around 111. But what's really nice about this as a trade idea or as a market to work with early in the week from an FX point of view is the fact that we're in new territory, and you've got the volatility from an interest rate announcement as well. So for that, I really, really like the Australian dollar against the Japanese yen. The second market that I want to look at is the S&P 500. Now, both the S&P and the Nasdaq have closed at all-time highs at the end of last week, and I think they're very, very interesting markets in this position now to work with. Now, traditionally, a lot of traders get frightened off of working with markets that are constantly pushing at all-time highs, and it's understandable because you have nothing to the left. You have no structure to the left with you to work with, and this is actually a case where indicators can really come in and help you because there's so much emphasis on them because you have so little price action to actually work with on a day-to-day basis. But that's not really the key reason why I think these are interesting. I think there's an element that's potentially been missed that is being priced in, and that is the fact that we're now going to enter into a phase where we're handing over, we're changing the Federal Reserve Chairman from Jerome Powell to Kevin Warsh, and he's going to be coming in the next month or so. That in itself is an absolutely huge deal for markets. In all my time of working with markets, the first Fed chair that I saw was Alan Greenspan, and then Ben Bernanke, and then there was Janet Yellen, and then Jerome Powell, and now we're going to go to Kevin Warsh. Each time you get that changeover, there's always an awful lot of uncertainty as markets try and figure out who this guy is, what he's going to do, how he's going to see the economy, and what that is going to mean for markets and trading down the road. It's a very, very interesting time to get involved in markets when you get that transition from one to the other. And Kevin Warsh is known as being very, very dovish. Now, last week, the Federal Reserve meeting, there was a split. Some of the Fed members were starting to push against the dovish tone and were remaining hawkish. Now, Kevin Warsh is pretty dovish. So what does that mean? Kevin Warsh is for loosening monetary policy. He's for lowering interest rates, putting money into the system. That money that goes into the system has to go somewhere, and it usually goes into businesses and risk assets, primarily the stock market. So what you tend to find, in a sense, when you got a sense of dovishness or lowering of interest rates, you get that push of funds into risk assets, primarily the indices, the S&P 500 and all of the other equity markets. And it's that I think is very interesting. Now, anyone that's been trading for any length of time will know that markets do one thing very well, and that is they like to price things in ahead of time. So I would argue, I would debate with anyone, that an element of this massive upsurge that we've seen in the S&P 500 recently, there's a component of that as the market now starts to know that it needs to factor in the Kevin Warsh impact that that's going to have on monetary policy and markets over the course of the next 6 months. That is an element that I think gives us a very, very good opportunity. So what I'm trying to say is when we get to non-farm payrolls, on Friday, the market is expecting a pretty low number that will support a dovish case. So I would say that we've got a technical picture now, which is going to give us really, really nice trading opportunities. And I think volatility is going to expand. So from a technical perspective, what you've got at the moment that's forming on the daily, I'm going to call it. It's a little bit early still, but I am going to call it. And that is, I think we're going to get some kind of a broadening pattern, a broadening formation. And these are my favorite technical patterns to work with. Why? Because as they expand, they give you longer to work with them to pull off some really nice moves. They become more volatile as the market pings from one side to the other. That in itself can get some great opportunities. And what it's showing us is a market that's really starting to move to be quite indecisive as people don't really understand exactly which way we're going to be trending. And as a result of that, people get washed out either side, which is why we get this expanding sort of like reverse triangle effect as we get higher highs and then lower lows that sort of start to expand out on themselves. That gives us a really, really nice technical pattern on the daily time frame to drill into as we move into non-farm payrolls on Friday, and I suspect that's going to give us some fantastic moves. So for me, I want to focus primarily on the Australian dollar and Japanese yen early in the week, and then the S&P 500 as we move into non-farm payrolls.